Daniel here, General Concepts. I'm going to talk about using annuities. So as I've talked about before in some of my previous videos about annuities, they're known for their lifetime income. Once you turn on that income, it will keep paying you. And in most cases, it depends on how it's set up, on how the contract is set up. But ideally, it will pay you with cost of living increases for the rest of your life. So especially if you outlive their life expectancy of what they have calculated that your probability is. So what some people will do is they will take those and say they're at a much younger age, they have a lump sum of money, and they'll take it and they will put it into an annuity contract with an income rider, and they'll turn on the income. Well, there's two different strategies. But they'll turn on the income. They will pay for a life insurance policy forever. It'll just keep paying it out. They'll keep using that for premiums. And of course, the life insurance policy will grow over here. This will continue to generate income over here. And that's one way to do it. Another way to do it is some people do it for the short term. And I say the short term, they do it over 10 years. And they will get one that has 10% free withdrawals. And mind you, this is non-qualified money. So this is not money that was in an IRA or a 401k. That was rolled over to an annuity. Because if they're under 59 and a half, then they would have to pay the 10% penalty. So that's not necessarily recommended. So this being non-qualified money, meaning this is just money that they paid into an annuity and it was after-tax money. They put it in there and it kept giving off an income. And of course, the life policy continues to grow and will do its own thing. And they never had to come out of pocket additionally. And ideally, the annuity kept paying out until they were in their old age. And I got off track there because the other way was you can take out 10% free withdrawals. Sorry about that. And you take out those 10% free withdrawals and you would take that, and it's a free withdrawal. So there's no penalties of any sort for that. And you're able to take that money out each year, and then they put it towards, say, a 10-pay life policy where they're only going to pay for those 10 years, and they're going to kind of front load it, if you will, as opposed to the other longer term strategy. But they're going to front load it, and each year up to 10 years, and in many cases, because lost my train of thought there for a second. And in many cases, because it is an annuity and there is a crediting rate, there's a growth rate, even though you're taking out those withdrawals, there's still some growth. And so it may go a little beyond that. And it depends on the company, depends on the crediting rate. They may have a good crediting rate or a good situation, and it may go on even longer. Probably not in the same amount, probably in a lower amount. And it also depends on the actual annuity, because some annuities allow you to take out 10% of the original amount. Others are 10% of the current amount. So if it's one that's from the original amount and it stays that way ongoing, then of course the money comes out a little quicker. Where if it's 10% of the amount right now, well, it's going to be a decreasing amount each time and will take that much longer to withdraw all the money. So that's another strategy. That's another way to maybe manipulate's a bad word, but to basically leverage an annuity contract into life insurance. Please hit the notification bell, like and subscribe. And I'm doing multiple videos at a time, so probably see this shirt again. Catch you on the next one.